It's been a historic couple of years. If you look at the S&P 500, it's as concentrated as it's ever been, with 10 companies making up 40% of the index. A lot of this has come from underlying earnings growth, however. It's not necessarily, like we just talked about, a meaningful deviation from fundamentals. It's the largest companies that produce the bulk of the earnings growth in the S&P 500. And looking ahead, that continues to be the case. If you look at the market cap weighted S&P versus the median S&P stock, those companies at the top of the market continue to offer premium EPS growth going forward. And that's a function of having economies of scale, the ability to move your supply chain around to navigate some of these input cost pressures. The largest companies tend to have labor costs that are a lower percentage of their total revenues. So a lot of things kind of working against the median stock are actually things that have worked for the larger segment. And that's why we started to see this bifurcation over the last couple of years and why it's potentially going to continue here, even though we would love to see a broadening out of performance. If you go back to November 2022, AI-related companies have accounted for 75% of the S&P's total return. 80% of the index is earnings growth and 90% of the index is CapEx. Just incredible levels. That's why we've seen so much concentration. And as long as that CapEx is going to continue, it's hard to say that concentration is going to turn anytime soon. And just looking at this year, just 8 companies, the Mag 7 and Broadcom, have accounted for half the S&P's total return. And those same 8 companies have accounted for more than half of the S&P's total return over the last 3 years. It's been a tough market for active managers. There's, only 23% of companies are outperforming the S&P over the last 3-year period. We still think that there's a ton of opportunity in active management and using fundamentals, especially as the cycle ages, and we're going to see earnings growth become a more important driver of performance. But certainly been just a remarkable couple of years in equity centered around the AI theme. And then on the next page, you just wanted to have a look back at the last 6 or 7 years of the Mag 7 versus the average stock. And this is why we've ended up where we are today. This is remarkable earnings growth for the Mag 7. It's just vastly outpaced that of the average stock. So in many ways, it's been fundamentally driven concentration in the market. And it's hard to say that this is going to turn anytime soon. On the next page, I wanted to quickly touch on underneath the surface of the market, looking at different segments and seeing where the earnings growth and performance has come from. And the Mag 7, despite being down almost 25% peak through the April lows, is now back in front, up over 20% for the year. And over 80% of that return has come from underlying earnings growth. Similar story for the large growth segment. A lot of their return has come from underlying earnings growth. And what jumps out to me on this page is that the Russell 2000 still posting a respectable 13% total return for the year, but none of that has come from underlying earnings growth. It's been sort of when is the Russell 2000, when is the small cap segment going to show the earnings growth? I think a lot of the performance and multiple expansion is based on the expectation of future earnings growth. And as you can see on the right, for 2026, most market segments around the world are sort of expected to see double-digit earnings growth. Small caps jump out again as a segment that is expected to see 40% year-over-year EPS growth. That's very similar to what we expected for this year. And if you just turn to the next page, small caps, despite coming into the year with lofty expectations, have failed to really produce any earnings growth. And we've seen these downgrades throughout the year to the small cap year-over-year earnings growth estimates for 2025. As Cameron says, just because it's consensus doesn't mean it's going to happen. And I think we would certainly love to see better participation from the smaller cap segment. We think there's a lot of opportunity for stock selection here, but the environment has certainly been challenging relative to the large cap space when you think about where the earnings growth is coming from and what the headwinds that the average small cap company are facing. On the next page here, we have a quick look at the S&P 500 and projected earnings growth. And really, this is just illustrating that the trajectory of earnings growth drives price. And that's what you see in this blue line is that as long as the earnings expectations are rising, typically the S&P 500 tends to follow. And when you see the earnings environment, when the earnings expectations fall, it's usually a headwind to equity prices. So these earnings expectations for 2026 have continued to grind higher. That's one reason why the market has continued to perform well. And then just lastly, touching on valuation, I think it's fascinating that the Mag 7, despite all of its outperformance over the last couple of years, is actually not that expensive compared to the rest of the S&P 500. It's always traded at a premium, but that premium is down from, say, a 50% average. It trades around a 35% premium today. So once again, tells you that a lot of the performance of the Mag 7 has been hard earned from earnings growth. And when we look at the equal weight S&P 500, there is a substantial discount here relative to the broader S&P. I think this is part of the story with the small cap segment as well, is that there is an opportunity from a valuation standpoint, but we're not seeing the underlying earnings growth to provide the other piece of the puzzle here. And so we'll see what 2026 brings, but ultimately we think that this is probably a market that favors the large growers and sort of the piece of the market that has those AI tailwinds relative to sort of the other 493 or the average stock. And as you can see, the S&P is still trading at, at the high end of its historical range. 22 and a half times forward is about as expensive as we get. We did get up to 25 times back in the tech bubble, but this is certainly something to be mindful of. A lot of this valuation, the market's been able to sustain this valuation because of its healthy earnings growth and exposure to just these AI infrastructure names that have produced so much fundamental growth. And lastly, on the positioning in the equity markets, this has been a certain tailwind over the last couple of months. We crossed our sort of average threshold, and now we're kind of just back to maybe a little bit above average in terms of consolidated investor positioning. Certainly something to be mindful of. As this ticks higher, it likely means that you should expect maybe equity markets to be fully priced, fully valued, or those tailwinds from the rebuilding of positioning tend to fade. It just means that likely means for a little bit more of a challenging environment for the overall equity market. And one more slide is just our outlook for our scenario analysis for the S&P 500. And I think just looking at the bottom half of this page, you can see that, on 2026, EPS expectations are for around $300 per share at a sort of 23 multiple. That's around 6,900 on the S&P 500. That's, a little bit above where we are today. So it tells you the market is still pretty fully valued. Certainly could see EPS come in a little bit above or below this number. And we could see the PE on the index range from 20 to 21 on the low end to 25 on the high end. So expect a wide range of outcomes, but it does feel like the market is certainly gravitating towards the higher end of this valuation range.